Welcome to Capital Allocation LabCom, audio-first lessons that turn classic investing ideas into practical decisions for owners and long-horizon investors. If you find value in episodes like this, subscribe and like to support more educational episodes.
Today, we are undertaking a deep dive into, one of the most critical aspects of long-term wealth building. It's about separating market price from business value.
Right.
This isn't about trying to predict the next market move, not at all. It's about establishing a policy, a set of rules that dictates how you behave when market fluctuations inevitably arrive, because they will.
Our mission today is really to build a durable process. We're talking about a policy, not prophecy, mindset. And the core guiding principle for this whole discussion is, it's simple but pretty profound. Price is a servant, not a guide.
Exactly. Price is just information, an offer.
The market's going to quote us a price every second, every day, right?
Right.
And our real job, is to maintain that internal discipline, to use that quote only when it serves our long-term goals, not just because it's there and screaming at us.
Precisely. We're basically translating the classic Mr. Market parable. The moody business partner who shows up daily with some irrational price offer. We need to adapt that for today.
Yeah, things are a bit different now.
They are. This means accounting for modern realities, things like massive flows from index funds, ETFs, big corporate buyback programs, and just the constant psychological pressure from having real-time screens in our pockets.
The ultimate goal here is process durability. We want a policy, a framework that completely ignores whether the next headline is super euphoric, suggesting, limitless upside, or absolutely terrifying, suggesting collapse. It needs to be a blueprint for quiet, rational action, staying calm.
And as always, this is educational. It's not individualized advice. We're providing frameworks, rules that you, the listener, can hopefully adapt and implement into your own policy statement. So let's jump in.
Okay, Section 1, the core principle and the modern context. Let's start by defining volatility, because that's really the source of all the opportunity, but also all the noise, right?
That's right. We know prices move because expectations move. The crowd, it swings. It goes from overwhelmingly optimistic one day to profoundly anxious the next.
Yeah.
Sometimes in the same day.
Yeah, the sentiment shifts fast.
But here's the key mechanism, the thing that creates the opportunity. These expectations, often driven by sentiment, by headline risk, they can swing drastically faster than the underlying business fundamentals actually change.
Okay, give us an example.
Well, think of a really durable business. Its cash flows might dip, maybe 5% in a recession. That's normal. But the price of that stock, it might fall 40% or more.
Wow.
That rapid divergence, that huge gap between the price movement and a much smaller change in business reality, that is the gap between price and value that patient, true owners want to exploit.
So if I'm thinking like, say, the owner of a private factory, a short-term price quote on some publicly traded shares, it isn't really a judgment on my factory's worth or my decisions. It's just an offer, someone shouting a number.
Precisely. As an owner, you have a distinct choice. And this is really the core of the mentality we're advocating for today. You can accept the offer, meaning you transact, you sell, maybe you buy more, or you can just decline it.
Ignore it.
Ignore it. Continue holding the asset, collect your cash flows, your dividends, while the underlying business just keeps compounding its intrinsic value over time. The business hasn't changed just because the quote did.
So the practical mindset then becomes, use volatility, don't fear it, turn it to your advantage.
Absolutely. The actionable framework is simple in concept, though. Let's be honest. It's difficult in practice because of our emotions. But the framework is, when prices fall far below what your own sober analysis defines as reasonable value, you should add.
Buy more.
Buy more. When prices soar far above that reasonable value, you trim, you lighten your position, lock in some gains, rebalance.
And the rest of the time?
And in the vast, noisy middle, which frankly is where the market says probably 80% of the time you ignore the tape entirely, you let your defined policy run without emotional interference.
That distinction, acting only at the extremes, that feels like the key behavioral guardrail. It saves investors from, themselves.
It really does.
But let's step back. Look at that classic Mr. Market parable again. How does it hold up today when the market feels so much faster, so much more algorithmic?
Well, the original concept, just to recap, you own a private company with this very moody partner, Mr. Market. He knocks every day with a price quote. Some days he's ecstatic, offers you double what you think it's worth. Others, he's severely depressed, offers half.
His mood swings are wild.
Exactly. But the critical insight, which is absolutely timeless, is that his mood doesn't change the fundamental value of the asset one bit. Whether it's a bakery's secret recipes or a software platform's recurring revenue, the underlying business is what it is.
So the edge comes from choosing when to transact based on my own appraisal of value. My homework, not his emotional state.
That's it.
If his price is silly high, maybe I sell him a small slice. If it's silly low, I buy his slice. If it's just reasonable.
You just thank him for the quote, maybe offer him a coffee, and get back to focusing on the business itself. It's about that separation.
Right. The parable is really a call to rigorously separate value from price, isn't it? And to maintain your own appraisal, keeping it updated with fundamentals, revenues, margins, balance sheet health, reinvestment potential, management quality.
All those core factors, the quotes are just external inputs. They are never internal instructions on what to do.
Okay, but you mentioned the modern update. How do things like ETF flows, index mandates, corporate buybacks, how do they complicate Mr. Market's offers today?
They don't change the fundamental relationship between price and value. That gap still exists. But they dramatically affect the speed and the magnitude of the price movements. Mr. Market's offers are now heavily influenced by massive, often programmatic flows.
Money just moving because of rules, not decisions about value.
Exactly. Money moving into or out of index funds based on mandates, or huge corporate buyback programs, creating constant institutional demand, or sometimes selling pressure. This means liquidity, the flow of funds, can move prices very quickly and often exaggerates those short-term gaps between price and value.
So that microstructure, those plumbing issues almost, they just reinforce the need for a policy, right? If algorithms and passive flows are driving the price moment to moment, trying to time those moves is, well, it's impossible. You need a mechanical rule.
Exactly right. The modern market, with all its speed and flows, it actually reinforces the need for policy over prediction, because the policy tells you how to behave regardless of the immediate, often random, flow-driven price movement. It locks in rational behavior when things get chaotic.
Okay, let's get specific then. Section 2, policy over prediction. You mentioned 2 rules-based playbooks for long-term durability. Let's start with the defensive allocator policy. What's the main focus there?
The defensive allocator policy is really built for simplicity and maximum durability. Its core goal is kind of triple layered. First, protect purchasing power from inflation. Second, participate reasonably in long-term growth. And third, maybe most critically, avoid major permanent capital impairment mistakes. It's designed for low-regret investing.
Low regret. I like that. So how does it work?
Well, the calm, rules-based setup starts with an anchor and a corridor. We generally advocate maintaining a default 50-50 anchor between stocks and bonds. Think of this as the balanced, neutral starting position for the long haul.
Why 50-50 specifically? Is that magic?
Not magic, but historically it provided excellent ballast. When equities get hit hard, high-quality bonds often rally, or at least hold their value much better, which smooths out the overall portfolio volatility. It helps you stay invested.
Okay, so the anchor is 50-50. What about the corridor?
The anchor itself is crucial, but equally important is the corridor. We suggest allowing the allocation to drift within a pretty wide 25%, 75% corridor for stocks. So your stock allocation could range anywhere from 25% to 75% of the total portfolio without triggering an immediate adjustment.
I see the thinking there. The wide corridor accepts our inability to forecast, right? It lets you ride bull markets up. But that fixed 50-50 anchor, it stops the portfolio from just quietly drifting into, say, 100% stocks during a mania, or maybe 100% cash during a panic. It keeps you grounded.
That's exactly the idea. It provides boundaries. Now let's detail the rebalance mechanics. This is really where the policy executes that buy low, sell high discipline automatically, without emotion.
Okay.
We strongly recommend checking the policy only twice a year. Pick 2 dates, say January 1st and July 1st, and stick to them. This reduces unnecessary tinkering and trading.
And what are the actual rebalancing rules when you check?
There are 2 simple mechanical rules you can choose from. Rule 1 is what we call the nudge. You rebalance back to your 50-50 anchor if either sleeve stocks or bonds drifts by approximately 5 percentage points from that target.
So if my stock target is 50% and stocks have a great run and now they're 55% of my portfolio,
then on your check-in date, you'd sell 5 percentage points worth of stocks and use the proceeds to buy 5 percentage points worth of bonds. That brings you right back to 50-50. Simple.
that's clear. But what if the market has a major crash? Say stocks fall from 50% down to, I don't know, 35%. That's a 15-point drift below target. Using the nudge rule means selling 15% of my safe bonds and buying 15% more of those volatile stocks. That sounds psychologically very tough to do in the moment.
It absolutely can be, which is why we offer an alternative. Rule 2, designed for simplicity and, frankly, behavioral comfort.
Yeah.
The 1/11th rebalancing rule.
1/11. Okay, how does that work? Sounds a bit strange.
It just means you move approximately 1/11th, which is about 9% of the gap, back toward the target at each semi-annual checkup. Let's walk through that 35-65 example you just gave.
Okay, so target is 50-50. Stocks fell hard. Now I'm at 35% stocks, 65% bonds.
Right. Your stocks are 15 percentage points below their 50% target. The gap you need to close on the stock side is 15 points.
Got it. So the gap is 15 points.
Correct. With the 1/11th rule, you move roughly 9% of that 15-point gap back towards the target. So 9% of 15 points is about 1.35 percentage points.
Ah, okay. So instead of moving the whole 15 points, I just sell 1.35% of my bonds and buy 1.35% more stocks.
Exactly. It's a much smaller, more incremental move. It feels less dramatic, less scary, but it's still mechanical, it's unemotional, and crucially, it forces you to take continuous, countercyclical action, buying stocks when they're down, selling a bit when they're up, just in smaller steps.
I really appreciate that numerical breakdown. That makes the 1/11th rule much clearer. So whichever rule you pick, the nudge or the 1/11th, the practical result is the same. Volatility actually becomes an automatic rebalancing feature.
That's the beauty of it.
When stocks fall, the policy forces you to buy more shares, automatically lowering your average cost over time. When they surge, you're forced to trim back, resisting that dangerous urge to chase performance right at the peak.
Precisely. And this framework meshes perfectly with automated contributions, what people call dollar cost averaging, DCA. Any fresh cash you add automatically goes to the side of the portfolio that's currently below its policy target.
So bear markets become automatic discount shopping trips funded by your regular savings.
You got it. It changes the whole psychological dynamic from fear to, well, almost quiet satisfaction that your plan is working as designed.
Now, in this defensive policy, it's critical how we define risk, isn't it? It's not just about the paper drawdown number on your statement going down temporarily.
No, absolutely not. The risk that truly matters, the one we need to protect against, is permanent impairment of capital. That's the loss of capital that you can't recover because the underlying asset itself has fundamentally failed, or because you were forced to sell at a terrible price due to needing cash for external reasons. Short-term fluctuations are just noise, data points. They aren't risk in the true sense if the asset is sound.
Okay, let's talk composition for this defensive approach. What should the bond core and the equity core look like? Quality matters here, I assume.
Absolutely. For the fixed income side, the quality core should favor high grade, meaning safe, intermediate-term bonds. Or you could build a simple ladder of individual bonds with staggered maturities.
Why intermediate term specifically?
Intermediate terms are crucial because they limit duration risk, that's the sensitivity of bond prices, to changes in interest rates while still offering a reasonable yield, usually better than very short-term bonds.
We should probably quickly define call risk, too, while we're on bonds. That's a nuance people might miss.
Good point. Call risk is the danger that the entity that issued the bond, especially when interest rates drop significantly after they issued it, will choose to redeem the bond early, essentially pay you back your principal before the stated maturity date.
And that's bad because...
It caps your upside. You get your principal back right when you'd most want to keep holding that higher-yielding bond, because now prevailing rates are lower. It forces you to reinvest your money at those less attractive lower rates. So you need to check if your bonds have call features.
Noted. Okay, and for the equity core in this defensive strategy?
For maximum simplicity and diversification, the most effective approach is usually broad, low-cost index funds. Think total stock market or S&P 500 type funds.
And if you do want to pick individual stocks within this defensive framework?
If you do, you should really stick to large, established companies that are conservatively financed, meaning low debt, and ideally have a history of paying dividends. And crucially, they should be bought at sensible, non-euphoric valuations. The overall focus here is stability and resilience, not shooting for the moon.
Let's try to make this concrete with that example profile you mentioned. Profile B, the 6-year-old business owner, may be focused more on income durability as they approach retirement. How would their policy look?
They could still use the same 50-50 anchor as a starting point, but they might adjust the corridor. Perhaps tighten it a bit, say to 30-70 stocks bonds up to maybe 60-40, reflecting a lower risk tolerance. Or they might simply anchor at a higher bond allocation, maybe 40-60 or even 30-70.
And the emphasis shifts slightly.
Yes, the emphasis shifts towards planning explicitly for drawdown protection. For instance, ensuring they have enough cash and high-quality fixed income set aside to cover several years of living expenses so they'd never be forced to sell equities during a steep market correction, say a 30% drop. Liquidity planning becomes paramount.
Okay, that covers the defensive allocator well. Now let's pivot to the other playbook, the enterprising investor policy. This sounds like it's for someone who actually enjoys the homework, reading filings, building simple models.
That's exactly who it's for. This policy is built for investors who have the temperament, the interest, and importantly, the time for detailed analysis. It adds a layer of rigorous valuation band discipline on top of potentially a diversified core, or maybe focuses entirely on individual names. It requires developing and trusting your own internal sense of value, regardless of that daily quote from Mr. Market.
So what's the foundation here? It can't just be guessing.
No, absolutely not. The absolute foundation, the starting point, is calculating normalized owner's earnings. This is essentially a cleaned-up, normalized version of free cash flow.
Why owner's earnings specifically, and not just the reported GAAP earnings we see everywhere? And what does normalized really mean in practice?
Great questions. Reported GAAP earnings can be heavily influenced by accounting choices, non-cash charges like depreciation, which might not reflect the economic reality, or temporary cyclical spikes in profit. Owner's earnings tries to strip all that away to show the true amount of cash the business generates that an owner could theoretically pull out without harming the core operation's future.
Okay, so it's a truer measure of profit.
And
Normalized.
normalized means we don't just use last year's number. We use multi-year averages, maybe the past 5, 7, even 10 years, to smooth out the peaks and troughs of the business cycle. This is crucial to avoid the illusion where, say, a cyclical company looks incredibly cheap at the very peak of its cycle simply because its earnings are temporarily inflated. Rigorous normalization gives you a stable baseline value. It's the bedrock of non-emotional valuation.
That makes perfect sense. You need that stable baseline to judge today's price quote against. So based on this sober, normalized owner's earnings calculation, how do you establish those buying and selling bands?
We established 3 distinct bands for the specific companies on our watch list, and these bands are based on the implied forward returns at different price levels. The accumulation band is your buy zone. You'd look to add to your position when the current price, relative to that normalized owner's earnings, implies an expected forward real return of, say, 8% to 12%, or maybe even higher, using conservative assumptions about future growth and reinvestment. That range provides a genuine margin of safety.
And a hold band. That sounds self-explanatory.
Exactly. The hold band is that fair to reasonable valuation range, where the implied returns are acceptable but not compelling bargains. Here, you simply do nothing. You hold what you have.
And the trim band.
The trim band is where you start lightening up, taking some profits. This typically happens when the price has risen so much that the implied forward return falls below your predetermined hurdle rate. Perhaps it drops below 6% real return, for example. Or alternatively, you might trim if the underlying business fundamentals change for the worse, like if leverage unexpectedly increases, raising the risk profile without any compensating potential return.
When choosing these specific companies for the enterprising approach, you mentioned management focus is paramount. Why so critical?
It is absolutely critical. Over the long term, management quality and their capital allocation decisions are huge drivers of value. We prefer managers who consistently earn a high return on invested capital, ROIC.
Meaning they're good at turning profits into more profits?
Essentially, yes. They're skilled at taking $1 of capital, whether retained earnings or new debt equity, and turning it into more than $1 of sustainable, valuable future cash flow. Furthermore, they must deploy the company's cash rationally.
What does rational deployment look like?
It means they reinvest back into the business only when they have high return opportunities. If not, they should be returning cash to shareholders either by repurchasing shares when they are clearly undervalued or by paying dividends if those other two options aren't attractive. It's about that combination, high ROIC generation and rational capital allocation. That's what truly compounds owner value over time.
And finally, for the enterprising investor, there's the exit strategy. It seems easy to get attached to your story stocks, the companies you've researched deeply.
That attachment is a real danger. Exit humility is mandatory. If your original investment thesis breaks, maybe the competitive moat you identified starts to erode, maybe the unit economics of the business reverse and margins shrink permanently, or maybe management starts diluting existing owners with excessive stock compensation, you must exit the position without drama.
Regardless of the current price quote.
Regardless of the price quote at that moment. The underlying value proposition has fundamentally changed for the worse. Your policy must enforce the exit to preserve capital, even if it means taking a loss sometimes. Holding on based on hope is not a strategy.
Okay, that sets up the two distinct policy approaches. Let's move to Section 3, building your appraisal. Because to judge Mr. Market's quotes and enforce those enterprising bans, or even just to feel confident ignoring the noise and the defensive approach, you need an objective way to assess value.
Exactly. You need an objective owner's checklist. This is what moves you away from gut feelings or market sentiment and towards evidence-based decisions grounded in business reality.
Let's walk through the 7 core elements you suggest listeners should check regularly. This goes way beyond just looking at a simple PE ratio. What's number 1?
Number 1, unit economics. This is absolutely crucial. Are the company's gross margins solid? And importantly, are the customer payback metrics, how quickly they recoup the cost of acquiring a customer, resilient? You need to check this across different economic cycles if possible. You have to know if the core transaction, the basic business model, remains profitable, even when the economy inevitably slows down.
Okay, unit economics first. Number 2.
Number 2, balance sheet. Is the company sitting on net cash, or does it have debt? If it has debt, is it manageable even through a potential downturn? You must meticulously check for things like near-term debt maturities that could cause a crunch, or overly restrictive debt covenants that might force management into unfavorable actions, like selling assets cheaply if times get tough. Avoid distress risks.
Makes sense. Number 3.
Reinvestment runway. Can the business realistically reinvest its retained earnings back into itself at genuinely high incremental returns? Or is the core market saturated, meaning growth opportunities are limited? If growth is limited, management should be distributing that excess capital back to owners, not plowing it into low-return projects just for the sake of growth.
Good point. Number 4.
Moat and change. What specific element actually protects the company's cash flows from competitors? Is it high switching costs for customers, strong network effects, powerful brand, maybe regulatory protection? And then, critically, you have to ask, what macro trend or micro development could potentially erode those protections over the next 5 to 10 years? Always look for the potential change that could destroy the moat.
Constantly questioning the durability. Okay, 5.
Number 5, management's record. Have the current leaders actually earned your trust through their past actions, specifically in capital allocation? Look for clear communication about strategy, rational incentive structures that align management with long-term shareholder value, not just short-term stock price bumps, and genuine skin in the game. Ideally, managers should own a significant amount of stock purchased with their own money, not just receive options.
Actions speak louder than words. Number 6.
Valuation sanity. This is where you stress test things. Under conservative, maybe even pessimistic assumptions like lower future margins or slower growth than management predicts, are you still paying a price that allows for a wide margin of safety? If your valuation only works based on heroic, best-case scenario assumptions, then your margin of safety is probably 0, and that's dangerous.
And the last one, number 7.
Number 7, alternative use of cash. This is the crucial opportunity cost test. Ask yourself, if I didn't own this position today, would I actively buy it right now at the current price, given all the other options available? Or would I actually prefer to put that capital into a broad, diversified index fund, or maybe even a safe, tax-advantaged bond instead? Be honest with yourself.
That's a great list. And the key is consistency, right? You don't just do this once.
Absolutely essential. You need to reappraise these 7 factors on a set schedule, maybe quarterly, maybe semi-annually. Not every single time the price quote changes. Write down the results. Keep a file. A concise 2-page memo summarizing these 7 points for each holding is infinitely more valuable than having 10 screaming browser tabs open trying to react to the latest news.
Okay, let's try to apply this framework with a concrete example. Show us how to translate one of Mr. Market's emotional price quotes into a sober, rational expectation using those valuation bands we talked about.
All right. Let's assume we're evaluating a pretty durable, maybe mid-cap type business. Through our normalization process, looking at the past several years, we determined it reliably earns about $1 of owner's earnings per share on a through-cycle basis. That $1 is our stable starting point.
Got it. $1 of normalized owner earnings. Now we need a conservative growth estimate, right? How fast can that $1 grow?
Exactly. Let's project, again, conservatively, that this business can reinvest about 40% of those earnings back into itself, and it can do so at a solid, but not spectacular, 12% return on invested capital, ROIC. The other 60% of earnings, which it doesn't reinvest, let's assume it's either paid out as dividends or effectively compounded in your brokerage account at maybe 7%, 8% over time, representing broader market returns or bond yields.
Okay, so you blend those two parts, the reinvested part and the distributed part.
Right. When you blend the 40% growing at 12% and the 60% growing at 7, 8%, the total conservative estimate for per-share earnings growth pencils out to roughly 6% to 8% per year over the long term. And notice we're using a range, 6% to 8%, not a precise forecast number. That builds humility into the model from the start.
Okay, $1 earnings growing at 6-8%. Now let's see what Mr. Market offers. Ding dong, quote A. He knocks on the door and offers us the shares at $12 each.
Okay, here's the critical calculation. At a $12 price, the earnings yield is $1 divided by $12, which is 8.3%. Think of that as the immediate cash return you'd get if the business paid out all its earnings today.
Right, 8.3% yield.
Now, if we add our conservative 6% to 8% growth rate estimate to that initial 8.3% yield, the implied total return we might expect per year sits somewhere in the neighborhood of 14% to 16%. 8.3% plus 6% to 8.3% plus 8%.
Okay, 14% to 16% implied return. Now let's say my personal hurdle rate, my minimum acceptable return for taking on the risk of an individual stock is 10% real return. That 14-16% is comfortably above my hurdle. It's inside my accumulation band.
Exactly. So your pre-committed policy discipline mandates, add modestly. The analysis shows it's a strong offer based on your rules.
All right, now let's consider the opposite scenario. Mania time. Ding dong. Quote, B, Mr. Market's euphoric today. The quote is $25 per share.
Okay, same $1 of normalized earnings, but now at a $25 price, the earnings yield immediately drops. $1 divided by $25 is only 4%.
Wow, big difference, only 4% yield.
Now, add the same conservative 6% to 8% growth projection. The business fundamentals haven't changed, only the price. Your implied total return compresses significantly, down to maybe 10% to 12%, 4% plus 6% to 4% plus 8%.
That 10-12% range, it's much less compelling. It might be right around my 10% hurdle rate, maybe slightly above, maybe slightly below, depending on my precise growth assumption within the range.
Correct. So that result is now likely a hold-to-trim decision. The margin of safety has shrunk dramatically. The business has shifted from being a clear bargain at $12 to being maybe fairly valued, perhaps even a bit stretched, at $25.
The key point here is the clarity this process brings, isn't it? We translate an emotional price quote into a sober, numerical expectation using ranges and humility. Then we act strictly according to our pre-committed bands. The price is serving the valuation work. The valuation isn't being manipulated after the fact to justify chasing the price.
That's the essence of it. Price is input, not instruction.
Now, to make sure our valuation isn't just based on one method or wishful thinking, you mentioned using a toolkit of sanity checks.
Yes, it's good practice to triangulate value, to check your work using a few different angles. This helps prevent model complacency or falling in love with your own assumptions.
Okay, what's in the toolkit?
First, the yield approach we just used. Start with normalized owner's earnings, divide by the current price to get the earnings yield, and then adjust that yield upwards by adding a conservative estimate for future growth to infer the implied total return. If that implied return sits robustly above your hurdle rate, that's one check mark.
Makes sense. Second check.
Second, the comparable sanity check. Don't evaluate your target company in isolation. Look at a small, carefully selected peer group of similar quality businesses in the same industry. See how the market is pricing their cash flows, their growth prospects.
And then the crucial step.
Then, crucially, always penalize your preferred company with a safety haircut. Assume, for the sake of argument, that it's slightly worse than its peers, maybe less efficient, maybe lower growth. If you still like the investment's valuation after applying that penalty, then it passes this resilience test. It suggests the value isn't just relative, it might be absolute.
I like that. Forced humility. And the third check.
Third, you can use discounted cash flow, DCF corridors. Now, DCF models are often criticized for being complex or allowing too much manipulation, but you can use them simply to establish reasonable guardrails. Model out low, base, and high scenarios for future cash flows.
And the key assumptions to control there.
Two key humility components. First, cap your terminal growth rate. That's the assumption about how fast the company grows far out into the future, forever at or below the expected long-term growth rate of the overall economy, GDP. A company cannot outgrow the economy forever. Second, test a range of discount rates to see how sensitive your valuation is to changes in interest rates or risk perception.
So the goal isn't a single magic DCF number.
No. Absolutely not. The outcome you're looking for is a plausible zone of value. If the current price falls comfortably below the low end of your conservatively derived zone, that's another strong checkmark. If all three methods yield, comparables with a haircut, and DCF corridors point toward the stock being undervalued, you have much higher conviction.
And the unifying theme across all these tools is consistency, right?
Right. Consistency is paramount. You have to use the same methodology, the same conservative haircuts, the same review cadence every time you evaluate a company. Changing your method or your assumptions simply to fit your current mood or to justify buying a hot stock that looks expensive. Well, that's exactly how emotional self-deception creeps into the spreadsheet and destroys the entire purpose of the process.
Right. The process has to rule the emotions. Okay, let's move to section 4, navigating modern frictions and investment building blocks. How do some of these external modern market realities, things like high-frequency trading, inflation, shifts in capital return policies, influence how we execute our calm policy?
These are important practical considerations. The first reality is just market microstructure. A lot of daily price movement today is often entirely flow-driven. It's passive money moving into or out of broad index funds at ETFs based on their rules or large institutions trading blocks. This flow can move prices dramatically, often in ways completely unrelated to any change in the company's fundamentals that day.
So how do you deal with that?
Your edge against this microstructure noise is patience, not speed. Trying to time those flows is a losing game. Instead, you recognize that those temporary flow-driven dips, when a good company stock gets pushed down for no fundamental reason, are precisely the opportunities your disciplined policy is designed to exploit. That's when your accumulation band might get hit.
We also need to consciously embed interest rates and the concept of duration into our appraisal process, don't we? Especially after years of very low rates, it feels like many investors might have forgotten how sensitive valuations can be.
This is absolutely critical, especially when you're assessing growth stocks, companies whose expected profits lie far out in the future. When prevailing interest rates rise, the present value of those distant future cash flows gets discounted more heavily. It moves much more significantly than the value of cash flows expected next year. That sensitivity is duration risk.
So a company promising big profits 20 years from now gets hit harder by rising rates.
Much harder. Its present valuation can get hammered when interest rates move up, even just 2 or 3 percentage points. So if you invest in long-duration growth stories, your valuation process must embed this potentially severe rate sensitivity into the appraisal. You need a bigger margin of safety to compensate.
Another key friction we have to manage is tax drag.
Yes, taxes are a huge, often underestimated drag on long-term returns. Frequent trading, especially realizing short-term capital gains, can easily turn, say, 100 cents of pre-tax gain into only 60 or 70 cents in your pocket after the tax man takes his cut.
So the policy needs to account for this.
Definitely. You must favor tax deferral by holding positions longer term whenever possible, and manage your bases carefully. This means harvesting losses, deliberately selling losers to offset gains elsewhere up to the annual limit when it makes sense from a portfolio perspective, rather than selling winners reactively just because the price went up.
This leads to a couple of important behavioral rules, doesn't it?
It does. First, adopt default inaction. Unless something fundamental has changed in your underlying business thesis, remember the checklist, your default action should be to do nothing. Don't trade just because the price moved. Second, and this is crucial for sanity, separate investing from entertainment. Turn off the constant push alerts on your phone. Commit to reading detailed company reports or thoughtful analysis, not just scanning breathless Twitter reactions or watching financial news channels all day.
Good advice. Let's talk about modern capital allocation. Mr. Market often expresses his opinion today through corporate buybacks just as much as through traditional dividends. How should we view those?
Buybacks can be a high... Second, the buybacks must actually shrink the total number of shares outstanding over time. They shouldn't just be offsetting the massive dilution that comes from excessive stock-based compensation grants to management and employees. If a company is spending billions on buybacks, but the share count stays flat or even goes up, they're essentially just transferring value from shareholders to employees, often while buying shares at inflated prices. That destroys value. You have to check the share count trend.
Okay, so scrutinize buybacks carefully. What about traditional dividends? Are they still relevant?
Dividends absolutely still matter, especially for investors who prioritize predictable cash income, like our Profile B retiree example. They provide tangible cash flow. However, you need to resist the temptation to just chase the highest yield you can find. Don't overweight a stock simply because it has a high dividend yield. If that yield is being funded by taking on excessive debt, or if it reflects declining business economics, A falling stock price pushes the yield up. The yield should be the result of underlying business strength and rational payout policy, not a substitute for it.
Makes sense. Now, back in the defensive policy, we talked about fixed income being essential ballast. We mentioned using intermediate-term bonds. Can you elaborate a bit more on how a bond ladder works to manage risk effectively?
Sure. Intermediate terms, as we said, limit that duration risk. The price sensitivity to rate changes. But building a simple ladder, where you hold bonds with staggered maturity dates, for example, owning bonds that mature 1 year from now, 2 years, 3 years, 4 years, and 5 years out, naturally averages your exposure to prevailing interest rates over time.
How does that help with risk?
It specifically protects you against reinvestment risk.
Which is a risk that when one of your bonds matures, you might have to reinvest that principal back into new bonds at potentially lower interest rates if rates have fallen.
Exactly. A ladder mitigates that risk because you always have some principal maturing relatively soon. In our example, 1/5 of the bond portfolio matures each year. This allows you to reinvest regularly, capturing the current yield environment, rather than having your entire bond portfolio locked into one potentially high or low rate for a very long time. When paired with your stock corridor and rebalancing policy, this bond ladder strategy creates a portfolio that can adapt smoothly to changing rate environments without causing panic.
That's a very clear explanation. Finally, let's touch on the inflation lens. Inflation seems to be back on the radar. How does that factor into our policy?
Inflation is like a quiet, constantly compounding tax on all idle cash, and, importantly, on every business that lacks pricing power. It erodes the real value of savings and profits over time.
So what's the antidote within our investment policy?
The primary antidote is owning businesses that possess genuine pricing power. These are companies that can pass through rising input costs, like materials or labor, to their customers in the form of higher prices, without losing significant market share. They can maintain their profit margins even in an inflationary environment. Look for businesses with strong brands, high switching costs, or network effects, things that give them that power. Resilience in the face of inflation is key.
Okay, so focusing on quality businesses with pricing power is the long-term defense. Great. Now, Section 5. Behavioral guardrails and stress testing. We've built the mechanical policy, but enforcing it requires controlling ourselves, right? We need guards against our own common human cognitive errors.
Absolutely. This is often the hardest part. Building the spreadsheet is easy. Sticking to it when markets get crazy is hard. We need practical behavioral controls.
Let's quickly review 5 common behavioral mistakes we often see investors make and suggest a better default action for each. What's the first one?
First is forecast addiction. This is the tendency to build incredibly elaborate spreadsheets and models that require the economy, interest rates, and company margins, all to cooperate perfectly for the investment to work out. It's an illusion of control.
And the better default.
The default.
Check.
Model ranges, not precise points, use scenarios. And let your policy, like rebalancing bands, handle the inherent uncertainty of the future, not your ego trying to predict it.
Okay, second mistake.
Second, confusing volatility with risk. Treating every short-term dip in your portfolio's paper value as a clear and present danger, leading to panic selling.
Default.
Judge risk only as the probability of permanent impairment of capital. If the underlying business is solvent, cash flowing, and has good prospects, then volatility is actually opportunity, not risk. It's the source of the mispricings your policy exploits.
Third mistake.
Over-optimization. Creating overly complex allocation strategies with 10 different asset classes, 20 moving parts, tactical tilts. It often leads to analysis paralysis or constant tinkering. Default. Choose fewer moving parts in your core strategy. Simplicity fosters stronger, unwavering commitment to the basic rules, which is far more important than finding the theoretically perfect but fragile allocation.
Fourth.
Ignoring balance sheets. Getting seduced by a great growth story or a high yield, while ignoring the fact that the company is loaded with debt. This allows undue leverage to turn a routine market downturn or operational hiccup into a potential solvency crisis.
Default.
Always prefer resilient financing. Actively screen for low debt or net cash positions. Avoid any reach for yield temptations that necessitate high leverage. Safety first.
And the fifth common mistake.
Loss of narrative control. This is allowing other people's market forecast, their sense of urgency, or their euphoria or panic to become your personal narrative and dictate your actions. Default. Put your entire investment policy, your anchor, your corridor, your rebalancing rules, your checklist on one single page. Call it your Mr. Market memo. And make it a rule to read that page first before you even think about opening your brokerage app or reacting to a headline. Reclaim control of your own narrative.
That one-page memo sounds powerful. Now, beyond those defaults, there are specific cognitive traps we fall into. How do we fight those?
Right. These biases are insidious because they feel like logical thinking in the moment. Take recency bias, the assumption that whatever happened in the last 6 months, good or bad, must continue indefinitely.
Antidote.
Before making any decision, force yourself to read a decade-long financial summary of the business or look at a 20-year market chart. Force the historical perspective to counteract the tyranny of the present moment.
What about loss aversion? That powerful feeling where the pain of a small loss seems to loom much larger than the potential pleasure of an equivalent gain, making us afraid to buy dips.
Antidote. 2 things. First, pre-commit to your buy bands when you are calm and rational. Second, ensure you size your initial positions and any subsequent additions, small enough that averaging down doesn't cause undue psychological pain or portfolio risk. Small steps overcome fear.
And social proof. The dangerous idea that if everyone else is buying, selling, they must know something I don't. Following the herd off a cliff.
Antidote. Keep a detailed decision journal. Write down why you bought or sold something at the time you did it. If your primary reason was simply other successful investors own it, or everyone on TV is bullish bearish, that's a huge red flag. Your decisions need independent analysis rooted in your policy.
And finally, the big one. Overconfidence. That feeling of being a genius after a few good calls or a bull market run, leading to bigger risks and less diligence.
Antidote. Always use checklists, like the 7-point one we discussed. Always value using conservative ranges, not heroic point estimates. And actively seek disconfirming evidence before you add to a winning position or make a new investment. Ask yourself, what's the best argument against doing this? If you can't find a good one, you probably haven't looked hard enough.
Great antidotes. Now, besides these general guards, you mentioned stress testing the policy itself with hard questions. A premortem.
Yes, this is absolutely vital. You need to sit down calmly now, before the financial storm hits, when you're rational, and write down the specific answers to tough what-if questions. This tests your policy's resilience and your preparedness.
Okay, give us the 5 hard questions we should answer in rating.
1. If stocks suddenly fell 30% from here, what exact action would your policy dictate? Which specific assets would you buy, e.g. total stock index, specific stocks on your list? And crucially, from which specific sleeves, cash reserve, bonds, etc., would you source the capital to make those purchases? Spell it out. 2. If interest rates across the board rose sharply, say by 3 percentage points, how would that immediately impact your view on your bond holdings? Would it change your preferred bond maturities or duration targets going forward? How does your policy adapt?
3.
3. Imagine your top individual stock holding. If its earnings multiple compressed by 1/3, so the price drops 33%, even with flat underlying earnings, what would you do? Would you add more based on your valuation bands, hold steady, or exit? And most importantly, why would that action align specifically with your pre-written valuation bands and checklist?
4. This one sounds practical.
4. If your primary source of income stopped unexpectedly for 6 months, maybe due to a job loss or a health issue, which specific assets have you set aside to fund your living costs without being forced to sell your core equity holdings at potentially depressed prices? This is essential liquidity planning, separate from your main investment allocation.
And 5. The flip side of a crash.
5. If one of your positions doubled in price quickly, maybe much faster than you expected, what specific portion, if any, would you trim? Would you sell just enough to de-risk, maybe take your original capital off the table? Would you trim it back to its original policy weight in the portfolio? Predefining your trim rule for winners prevents greed taking over.
Wow. Answering those 5 questions honestly and writing them down, that feels like the ultimate preparation. When the actual moment of crisis or euphoria arrives, you don't need to scramble or rely on raw courage. You just need to pull out your pre-written checklist and follow it.
Exactly. The act of writing down the answers now is arguably the single best behavioral guardrail you can possibly install. It front-runs the panic.
Okay, this leads perfectly into section 6, the action plan, the synthesis of all this. Your one-page Mr. Market memo.
Right. This is the ultimate practical takeaway. It's a template that listeners can literally copy and complete today. This memo codifies your entire policy onto a single sheet of paper and acts as that final, crucial behavioral guardrail we just discussed.
Let's quickly review the fill-in-the-blanks template so people know what goes on this powerful page.
Okay, start at the highest level, your overall mission. Objective? What are you trying to achieve? e.g. preserve and grow purchasing power at X% real return over the next 20-plus years. Allocation corridor, define your boundaries, e.g. stocks percent, e.g. 60%, bonds percent, e.g. 40%, default anchor, e.g. 60-40, corridor range, 40%, 80% stocks.
Then mechanics of discipline, the rules of engagement, rebalance, set your check-in cadence, semi-annual, Yan or Jill 1, detail your specific rule. Nudge rule, rebalance of drift off 5/8 from anchor or use 1/11th rule, move 9% of the gap at each checkup. Contributions, how do you handle new money? Automated monthly contributions, fresh cash automatically goes to the underweight asset class based on the anchor.
Next, define your quality standards. Quality rules. What assets will you hold? E.g. bonds must be high grade, intermediate term, or laddered. Equities. Broad, low-cost index funds or large, capable, conservatively financed individual stocks with trusted capital allocation history.
And if you're using the enterprising investor approach, watch list bands, if enterprising. Set your explicit buy trim thresholds based on your valuation work. E.g., add when implied forward return over percent, e.g. 10% real. Trim when implied forward return or percent, for example, 6% real.
Don't forget the practical and fiscal rules. Tax policy. How will you manage taxes? E.g. prefer long-term deferral. Harvest losses strategically up to one, e.g. $3,000 annually when beneficial for basis management. Liquidity. Your emergency fund, e.g. maintain months, e.g. 6-12 months, of essential living expenses in safe, easily accessible assets, cash money market, held separate from the main investment bond allocation.
And finally, the ultimate behavioral mandate, reminding yourself of the core principle, behavior. State it plainly. Quotes from Mr. Market are explicitly offers, not instructions. Use them only when my policy dictates action based on my predetermined value assessment. Review cadence. Lock in your process. Twice yearly appraisal of fundamentals for core holdings, if any. Make absolutely no decisions between scheduled reviews unless a fundamental thesis break, e.g. management change, moat erosion, unit economics failure, clearly occurs.
That's it. Print it out. Put it somewhere visible. When the next market scare happens or the next meanie takes hold, you read that memo. It provides immense psychological relief to know exactly what your rational self decided you should do, and just as importantly, what noise you should ignore.
And you also highly recommend writing a personalized letter to your future self to go along with the memo.
Yes, I think this adds an emotional anchor. That letter should basically confirm your commitment to the policy, especially under duress. Write something like, Dear future me, when Mr. Market is euphoric and prices seem detached from reality, remember. Sustainable high growth is scarce. Trust the process, and I will trim back towards my policy anchor. When he is fearful and selling quality assets cheap, remember. The cash flows from these businesses are durable, trust the process, and I will rebalance into them using my reserves or bond allocation as planned. My job is not to predict the future. My job is to behave rationally according to this policy.
And keep that letter right next to the one-page memo.
Exactly. Read them both together when things get stressful. It provides absolute clarity and resolve in the storm.
This is incredibly practical. Okay, Section 7, final takeaways and the quiet edge of waiting. We've covered the 2 playbooks, the valuation checklist, the behavioral guardrails, the one-page memo. Let's wrap up with some really actionable steps for implementation, maybe starting this week.
All right. We can think of an implementation menu offering 2 main paths. The first is the simple path, which relies entirely on low-cost funds.
What does that look like?
It could be as straightforward as 1 broad total market equity index fund, 1 high-quality intermediate-term bond fund, or building a simple bond ladder, and a small cash sleeve for liquidity. That's it. Then you simply rebalance between them back to your anchor, say 50-50 or 60-40, on your set schedule using maybe the 5-point nudge rule. For many, maybe most investors, that is a complete, likely high return and extremely durable long-term strategy.
Okay, that's the simple path. What's the alternative?
The alternative is the hybrid path. Here you keep that simple, diversified core portfolio as your foundation, but you layer on top a small, satellite sleeve dedicated to your enterprising ideas, those individual stocks you research using the checklist and valuation bands.
What's the critical rule for making the hybrid path work safely?
The absolutely critical rule is that the satellite sleeve must be kept small enough relative to the total portfolio, say maybe 10% or 15% at most, that any inevitable errors or poor stock picks within that sleeve don't significantly derail your main diversified financial plan. The core provides the safety. The satellite offers potential alpha, but with controlled risk.
That makes sense. Manage the risk of the active portion. And finally, you wanted to emphasize the quiet edge of waiting. What do you mean by that?
Just that patience in this framework is not passive resignation. It is selective action. Choosing not to transact when prices are within your wide hold band or when your defensive policy doesn't trigger a rebalance is an active decision. It's a decision to protect your attention from market noise, to protect your portfolio from unnecessary trading costs, and to protect your long-term returns from tax drag. Most days, honestly, the best, most disciplined move you can make in the market. The move that truly enforces your policy is simply no move at all. Waiting is a strategy.
That's a powerful reframing. Okay, let's summarize the 4 bedrock principles from today's deep dive that should really form the foundation of anyone's long-term investment approach.
1. Quotes are just offers. Policy always beats prediction.
2. Volatility is not the same as risk. Treat volatility instead as a rebalancing feature built into your policy.
3. Humility beats prediction every time. Pre-commit to your valuation bands, your review cadence, and your behavioral guardrails.
And 4. Value must drive your decisions. Let price serve your assessment of value, never the other way around.
Follow those principles, implement that one-page memo, and you've just built yourself a durable, rational, long-term response to whatever market volatility comes your way. It's a framework you can potentially keep and refine for decades.
That's the Mr. Market Playbook, a calm process that treats price as your servant and your own assessment of value as your absolute guide.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free and reach other long-term investors who might benefit.
Thanks for joining.
Remember, the market is not a judge handing down verdicts. It's just a very moody partner with a standing invitation to transact every single day. You always get to choose when and if you RSVP.